This is part of a problem-solving lecture series in investments. Today, we will have a look at problem 9 in chapter 2 from the 10th edition of our textbook. Here's a view of this problem. Let's go ahead and highlight some key facts provided in the problem. Find the after-tax return to a corporation that buys a share of preferred stock at $40 and sells it at the same price at the end of the year. However, we also receive a $4 end of year dividend. The firm happens to be on the 30% tax bracket. The best way to approach this problem is to see what is the capital gain and what is the dividend yield separately, I assume. So when we look at the capital gain is simply the selling price subtracted by the purchase price, $40 minus $40, which is $0. So in this particular case, the corporation is making no capital gain. However, it is obvious that the firm is making some dividend income at the end of the year, which is equal to $4. However, the corporate tax law gives the corporation 70% exclusion for preferred stock dividends. In this case, the taxable income would be 1 minus 0.70 times our dividend income, which is $4. As a result, we will see our taxable income will be $1.20. Now, we will therefore be paying taxes based on this figure here, $1.20. Therefore, our taxes due is equal to, knowing that we are in the 30% tax bracket, 30% of $1.20, which happens to be 36 cents. So therefore, our after-tax income, or you can say net income, so therefore our net income is the $4 revenue, dividend income minus the tax liability of 36 cents. And that brings us to $3.64 as our net income. Therefore, finally, the after-tax rate of return, after tax, that figure is equal to, so that's basically like a holding period return. You have a net gain of $3.64 for an initial investment of $40. And making the calculation, we realize our return from this investment is simply 9.10%. So that solves our problem. See you in the next video.